Now let's learn about expenses. So your book's definition of expenses is they are outflows of assets or increasing liabilities in the course of delivering goods or services to customers. I really don't like that definition, so I came up with my own. So here's my definition of expenses in red. It's spending money or promising to pay later for business-related items that do not provide a future benefit. So let's talk about some examples. So if you fill the gas tank of your delivery truck and you pay cash, two things are affected. Your cash decreases and you now have gas expense. Notice we spent money. We did pay for it with cash. And it's for business-related items. It's for your delivery truck. And that gas does not provide a future benefit. So this gas that you're going to be putting in your delivery truck is going to be used up relatively soon. It's not going to have a future benefit. So another example is you pay the phone bill of your business with a credit card. So notice it does, in this case, you're technically not spending money, but you are promising to pay later. So remember, when you use a credit card, you're not spending money yet, but you're promising to pay that credit card at the end of the month. So we are promising to pay later, and because it's a phone bill of the business, it's business related. And that phone bill that you just paid, that's for the past. It does not have a future benefit. So other common examples of expenses are the salaries that you have to pay your employees and utilities and rent. So we're going to find out on the next slide that expenses decrease owner's equity. And remember, the owner's equity account is called capital. But first, let's talk about something that confuses some new accounting students. So at the top of the screen it says, note, spending money on business-related items does not always result in an expense. For example, if you buy a vehicle for the business, that's not an expense because it does not meet the requirement that the expense does not provide a future benefit. Does a vehicle provide a future benefit? Yes. So buying a vehicle is not an expense, that's an asset. Remember, assets have a future value or a future benefit. So if you buy something like a truck, or a building, or a computer, that's an asset, not an expense. So let's see why expenses decrease owner's equity. So here's our accounting equation. Assets equals liabilities plus owner's equity. And let's say your business receives a bill for rent, and you immediately pay it, and it's $1,000 for rent. Which classifications are affected? And my hint again is the equation must always balance after you've entered the transaction. So let's start with the left side of the accounting equation, assets. What happens to assets when we pay $1,000? Assets are going to go down. So we're going to put a minus 1,000 under assets. So the company now has $1,000 less of assets. So what happens to the owner's equity? The owner's equity also has to go down by the same amount. And now our accounting equation balances. We have minus 1,000 on the left side under assets, and we have minus 1,000 on the right side.